Hi, this is Kim from Meritas headquarters. I would like to welcome everyone to today's Meritas Capability webinar, Essential Tax Strategies for U.S. Businesses in Canada. Today's presenters will be covering a 90-minute webinar, and they are coming to us from all across Canada, and they include Bill Cooper of Boughton Law Corporation in Vancouver, Harold Fetter of Brazo Seller in Ottawa, Cullen Green of Brazo Seller in Ottawa as well, Ray Hupfer of McLennan and Ross in Edmonton, Robert Korn of BCF in Montreal, Mark Andre of BCF in Montreal, and Michael Goldberg of Minden Gross in Toronto. Before we get started, I wanted to walk through a couple of housekeeping items. As all of you are likely aware, your phone line is muted. However, we do encourage you to interact with the presenters using the chat feature. And you can see that on the lower left-hand corner of your screen. If you type in a question, that message will go directly to our presenters, and they will be answering them at the end of the presentation. Should you have any technical issues, please hit *0 at any time, and there will be someone on the line to assist you. With that, Bill, are you ready to get started?
I am. Thank you very much, Kim.
Thank you.
Welcome, all of you south of the border. And I just wanted to briefly introduce our group here. I think some of you may have heard of us before, but we have a very strong group of tax people across Canada in all the jurisdictions. And we thought that it would be useful to do a presentation to give you an idea of the kind of problems we see that U.S. enterprises setting up shop in Canada are having in terms of their initial operations. And that's the purpose of today's webinar, is to provide you with sort of an outline of the key issues that U.S. enterprises face when they're setting up shop in Canada. This is a very strong group of tax people up here. This group was formed, we call it Meritas Canada Tax Group, was formed back in 2005. There's about 25 of us across the country. Some of us are both accountants and lawyers, and one member in particular has written extensively and is well published. So it's a good group of people. There's pretty much, there isn't any problem we can't solve. We've all worked on a whole variety of tax-related cross-border problems, and I just wanted you to know that there are people you can call if you've got problems, if you've got clients who've got problems in Canada, if you're not sure about the structures you're using or the financing methods, and simple things like having clients with employees in Canada can be a problem. So without further ado, I'm going to turn this over to our co-chair, Michael Goldberg. Michael will be introducing the speakers, and thanks for joining us today. And look for some materials coming up on the Meritas website after the presentation. Michael?
I don't want to slow the process down too much, as I said. I'm going to introduce the first speaker, who's Cullen Green. And Cullen is an associate at Brazo Seller. He works very closely with his clients and also with other advisors, assisting them with corporate, estate, personal, and international tax planning needs. Cullen's got particular expertise designing and implementing corporate reorganizations, and I see from his bio that he also plays ultimate frisbee. So, Cullen, I don't know how that affects your talk, but please go ahead.
Pivotal. Thank you so much. I hope that everyone can hear me okay, and it's a privilege to be able to address this topic. As Bill has noted, my focus of the conversation today is to help answer the questions of what do U.S. companies do when they have employees, contractors, moving pieces heading north of the border up to Canada to provide services to Canadian corporations. And frequently we see that companies frequently send employees or self-employed contractors up, and they start work, and we end up into a bit of a difficult situation. Oh, hold on for a second. I see that our slides are running a little bit rampant there. Let's just settle this back down. There we go. My apologies. So if people can just leave the slides alone, that will be greatly appreciated. So frequently what we have is that U.S. companies are in a position where they're sending employees or contractors up to Canada to perform a variety of services. And frequently these individuals are getting on site and performing great work for their clients, only to then encounter a variety and myriad series of withholding and tax requirements. And our message to Canadian and more importantly U.S. clients is almost always the same, which is that these things can be addressed relatively easily if we catch them early and we're able to provide an overview of the relevant issues so that clients can make a business decision with respect to how they want to proceed. So I'm going to outline 4 basic pieces to this equation. We're going to do a brief review of the Canadian federal income tax overview. We're going to address U.S. contractors who are paid by either Canadian or U.S. employers. We're going to overview U.S. employees, so scenarios where, for example, perhaps a U.S. corporation sends its employees directly up to Canada. And then fourth, we're going to briefly touch upon visa requirements because some immigration issues can arise when we are addressing the variety of tax solutions that need to be put in place. So, federal income tax. In general, U.S. residents are subject to Canadian tax on the following types of income: employment income earned in Canada, income earned from carrying on a business in Canada, and gains realized from the disposition of Canadian taxable property, in addition to Canadian source passive income. Overall, we could recognize this as basically being referred to as Canadian source income. Our focus here for today is on the first 2 types. So when we refer to federal income tax and to how this applies to U.S. corporations, let's just start at the bottom and work our way up. We know that U.S. companies that, quote, carry on business in Canada are subject to Canadian tax, absent a treaty exemption. The connection here is the key. They have a fixed geographic connection to Canada. So in the event that there is not a permanent establishment, however, Article 7 of the Canada-U.S. Income Tax Convention Treaty provides for no tax. So the key takeaway point here is to know the treaty. It's really your friend and will provide a series of tax exemptions as long as we have the correct structure in place. With respect to permanent establishment, I don't really want to dig in too much for today concerning the definition, but I think it is important that all of our listeners' clients are aware of the importance of this term, as it is kind of the central piece that really determines whether or not a client is going to have a Canadian taxation issue when they head north of the border. So the first point, and it's elemental, is to note the key role that a fixed place of business plays. As I said before, a set geographic location, and there's a dearth of case law on this point, really makes clear that if you have a set geographic location or an establishment, a warehouse, a variety of set areas, there's a very good chance that you're going to have a taxation issue. Second criteria that you can run into a problem with is the idea of a dependent agent. You have someone who actually has the ability to conclude contracts on your behalf, an authorized signatory. With the expansion and revision of the treaty recently, we also have some additional tests, the single individual test and the enterprise tests. And here I really just want to make the takeaway point that in the event that you have someone or your clients have someone who's spending a substantial amount of time, more than 183 days, or we're dealing with more than 50% of an individual's gross active revenue deriving from their source of employment in Canada, is that there is a potential issue to deal with a permanent establishment problem. Now, for most of today's presentation, we are assuming that we have been able to avoid this issue. Clearly, whenever there's a question or a concern about what the situation will be going in, it's best if we can work with people early, because the earlier that we're on site to deal with this, the more easily we can say, okay, well, if we shift our assets over here, or perhaps if you did it this way, you can avoid having a permanent establishment issue, and in so doing avoid a second layer of Canadian tax. So, federal income tax. If a U.S. corporation does not have a permanent establishment, it's really important to note that it may still be subject to certain Canadian income tax filing and withholding requirements in respect of subcontractors and employees performing work in Canada, i.e. no tax, but ongoing remittance, filing, and disclosure requirements. And that's really the focus of my presentation here today with all of you, is I want to make sure that we're setting out these disclosure and filing requirements so that we can help avoid nasty surprises. Because if there's a common solution, or a common scenario really, that we've seen in terms of many of the files that we've encountered, as we discuss on our monthly calls, is that employees have been sent up by a U.S. corporation that knows enough to know that it doesn't have a permanent establishment issue, but is then somewhat surprised to learn that there's additional filing requirements to which it is subject. So let's start with U.S. contractors working in Canada. As you can see, our Income Tax Act, paragraph 151.3.1g and Regulation 105 sub 1 provide for basic withholding, an amount of 15% of fees, commissions, or other amounts paid to U.S. persons for services provided in Canada. Now, the key point to take away here is that the payer is actually fully liable for the tax owing, in addition to penalties and interest, even if that payer is a non-resident. So we'll get into some examples in a little bit, but for now it's important to highlight that this means that we can have a scenario where one U.S. corporation is paying another U.S. corporation, neither of which have permanent establishments in Canada, with respect to services performed in Canada, and that there very well may be, in fact most likely are, tax requirements and filing requirements they need to be made aware of. So if services are provided in the U.S. and in Canada, I would note a blended service offering, for example, an apportionment may be made. So we can deal with the split of the percentage of the tax that would otherwise have to be withheld and submitted. One additional point I'd like to make with respect to Regulation 105 withholding is that it's not the end of the matter. This is merely the first step to dealing with a contractor or corporation's filing and compliance requirements. It's a partial solution. The first step is to make sure that we've addressed withholding, that we've addressed a waiver, and that then we've dealt with our filing requirements. So really, we could think of this as a three-step process. The first step is to figure out whether or not we actually have to deal with 105 withholding. That's our first step. Our second hurdle, as you'll see from the next slide, is that it may be possible to obtain a waiver. Whether or not we go down this route or not, though, it's not the end of the matter. The third process that then people need to be made aware of is that it's also going to be necessary to file forms with the CRA. In the event that we don't file forms or that our clients don't file forms, they can be subject, as before, to penalties and interest in addition to being responsible for the amounts in question. And the ironic issue here is that oftentimes there really isn't tax owing, but it's more a question of filing compliance, although of course it depends on a case-by-case basis. So just to offer an example, if a U.S. corporation sends a U.S. contractor, whether or not it's part of its own net corporate structure or a completely arm's-length third party to work in Canada to provide services on their behalf, absent a waiver, the U.S. company is required to withhold and to remit even though it has no presence in Canada. And this is always a shock when we address clients for the first time, when we take them through the system, when we take them through the analysis. They're always surprised to learn that the business affairs between two U.S. domestic corporations can still be subject to Canadian taxation with respect to services that will be provided in Canada, simply due to the geographic scope in which the services are provided. And this is where, if we have an opportunity to get on site early, frequently we can look at things and say, okay, well, can the majority of the services actually be provided in the U.S.? Can we restructure our contracts to try and make sure we have a more balanced offering that seeks to provide more services in the U.S. and to limit the exposure to Canada? We review all of the various options that we have to make sure we end up with the best possible scenario. Now I'd like to talk a little bit about U.S. employees working in Canada, because having addressed the U.S. contractor issue, it's equally important to address what happens when a U.S. corporation sends its employees up to work in Canada. And the frequent scenario that we encounter is that a little work is required, there's a server farm, there's something else, and before you know it, a U.S. corporation has popped a couple of employees up on a plane and sent them up north to do some work, only to then later discover that there may be some real issues on a variety of fronts. So U.S. companies providing remuneration to U.S. employees who are providing service in Canada are subject to the same withholding and remittance requirements the Canadian employers are subject to, absent the obtainance of a waiver underneath and pursuant to Regulation 102. So basically this means that U.S. employers, when they send their employees up to Canada, absent a series of other factors, have to deal with remitting and addressing income tax on a Canadian front, CPP, so our Canadian Pension Plan contributions, in addition to employment insurance, so EI premiums, all for their employees on a case-by-case basis. Now, starting at the bottom, I'd note that with respect to EI premiums, we can almost always avoid any issue there due to the reciprocity agreements that are in place, but it's still one of those things where we want to check through and deal with it on a line-by-line analysis. So when we speak of remitting, we have to deal with the remittance of the applicable income tax that would usually apply, the proper amount of CPP contributions and EI premiums, and employers are also required to do some additional work as well. In the event that they wish to obtain a waiver, they have to prepare and submit the necessary documents, background contracts, information, all that information prior to the employment in Canada, ideally 30 days before the employment begins. They also need to prepare and submit Canadian information returns on the same timeline as Canadian employers. Under the Canadian system, every year Canadian employers are required to generate a series of document information return forms, which they then provide, of course, to their employees. And the employees in turn then use those forms to prepare their income tax returns. CRA is provided an identical copy of those employment forms, which they can use to ensure that everyone is properly filing out their tax returns on an accurate and proper basis. So there's a fair amount of work that has to happen. Third, I would note that it's also necessary to apply Canadian individual tax numbers for each non-resident employee. And the reason for this is that CRA wants to be able to track whom is working where on what schedule. And so basically they need a tax ID number so they can track the exact amount of Canadian scope and source remuneration that each U.S. employee is receiving. Lastly, as mentioned, you'll have to deal with certificate of coverage from the IRS with respect to CPP in addition to a waiver of EI. So the Canadian Social Infrastructure Net provides its Canadian citizens with an array of social programs, which is great, but those programs come with a fairly heavy cost buy-in, which all Canadian employees pay into. So U.S. employees will actually be exposed to this, and more importantly, their employers will have to deal with all of the filing requirements, which can come as a shock if they haven't been prepared for the documents they're going to need to process and to work through. Plus, as previously noted, there are a series of penalty issues that you'd like to make sure that your clients are aware of. For example, you don't want them to get dinged for failing to provide the necessary tax information to CRA. You don't want them to have an issue with a fine with respect to failing to provide their employees with the necessary filing requirements. So it's frequently really important to make sure that we're working with the accountant, Canadian source and U.S. source if necessary, to overview the sum total of applications that have to be addressed to make sure that we can keep a relatively clean process. So let's continue this discussion with respect to U.S. employees working in Canada. As we said, Regulation 102 withholding is not the end of the matter. The withholding is on account of the U.S. employee's Canadian income tax liability. That employee has to then file an income tax return with CRA to obtain the refund, and the U.S. employer still has to issue information slips, as we've just discussed. The difficulty here, too, is we've had clients sometimes that have said, well, fine, how punishing it if I just don't pay? Can I just pay a fee? And that is a really, with respect, bad approach to take because, number one, it can be quite costly. But number two, CRA is in a position where basically they demand compliance from corporations when they send employees up the border. So the smoothest possible experience generally comes from addressing the issue early and taking it on a case-by-case basis. The second thing is that this can actually create a headache for employees as well in the event that they're not properly filing their returns, which could create difficulty for them in traveling and crossing the border. So our takeaway point on this slide is that payers remain fully liable for tax owing in addition to penalties and interest, even in the event that they're a non-resident. And that point really, I think, for today cannot be overstressed. It's important to understand that just because a corporation is based in the U.S. and hasn't, up until this point, had contact with CRA and all of their employees and assets and everything is based out of the U.S., they can still be exposed to CRA taxation when they end up having to send contractors or employees north of the border to assist with their business to perform work. So it's important to be aware of that exposure and to advise accordingly. As discussed, there is the option to obtain the waiver, but the key point I want to make, the key points, are as follows. Number one, the key is to do this early, to provide CRA with the array of necessary information that they require. CRA will typically require it 30 days in advance of the start of work, but the technical filing position is in advance of the first flow of payment or the start of the actual contract itself, the earlier of the two. And second, as discussed, it's important to note that just because you've obtained the waiver is not the end of the problem. We've seen a few scenarios where clients have come up and said, look, we understand, we've got this. We don't have a permanent establishment and we got a waiver, end of problem. And it's important to note that that's not the end of the entire journey. Although it is a very strong starting point, you need to then make sure that you've properly dealt with your filing requirements to continually satisfy CRA that no additional tax had to be paid. One exception that I'd just like to make sure that we note so that you are aware of and you can make your clients aware, and it's under the Canada-U.S. Treaty. Article 15 provides for an exemption if the total remuneration is under $10,000 on a calendar year basis, or the employee is not present in Canada for a 183-day period in a calendar year, and the remuneration is not borne by an employer who is a Canadian resident or a permanent establishment or fixed base in Canada. Given the issue that's here, it's frequently difficult to explain to clients why they have to go through all of the application process, but we highlight for clients that they still should apply for waivers in order to avoid the withholding requirements that otherwise employers can be subject to. The last thing that I'm going to touch upon is just briefly visa requirements for working in Canada. It's important that people be aware of the potential requirements to obtain a Canadian working visa for more than business visitors. As most of us know, under NAFTA, U.S. and Mexican business visitors may enter Canada to perform duties related to the business cycle. So this definition encompasses a fairly broad scope with respect to research and development, manufacturing, production, marketing, sales, distribution, and service. The key issue is that the primary source of remuneration and principal place of business needs to remain outside of Canada. Business visitors can't be there and cannot be viewed as entering in the Canadian labor market. If they're providing services directly to a client, it should be with respect to an overarching service that is provided from a U.S. corporation. It's important also to be aware of documents, letters, evidence, contracts frequently is something we've seen a lot of, that employees may be asked to provide at the border to substantiate that they are business visitors and that they're not seeking to enter the Canadian labor market. In conclusion, in some instances, both a Regulation 102 and a Regulation 105 waiver may be required. For example, if a U.S. corporation is paying a U.S. worker/employee for work sourced and performed in Canada, CRA is increasingly reassessing taxpayers and employers who fail to apply for waivers in advance in these instances. This can result in 10 to 20% of penalties for withholding, interest at the prescribed rate, which is admittedly quite low right now, and additional penalties for failure to file or to distribute a Form T4. Penalty is a daily amount, which is the total ranging from $100 to typically about $7,500. So it's important to be aware that this regulatory regime is increasingly changing and becoming more adverse as CRA looks to increase its tax base. With respect to best practices, I would simply close by noting the following. 1, in entering the Canadian workplace, we would suggest that people consult a tax professional to make sure that they are fully aware of the withholding and tax requirements that exist on both the form of the employer and the contractor and or employee. 2, we would suggest that employees and contractors, corporations, in prime, apply for requisite waivers early in the process. And 3, we would suggest that they file all necessary tax returns even if waivers have already been obtained. And with that, I'm going to turn it back over to Michael. Thank you.
Thanks very much, Colin. That was terrific and, of course, scary for anybody that's coming up here to Canada to try and do any work. The next presentation is a co-presentation, and it's been prepared by Natalie Woodbury of our Halifax, Nova Scotia office out on the East Coast with Wickwire Home. And Natalie is a member of our firm's Business Structures and Transaction, or her firm's Business Structures and Transaction, Estate Planning and Tax Practices. She's been advising and facilitating tax and corporate planning for private companies, estate planning for high net worth individuals, and succession planning for retiring business owners, including sales to third parties and transfers to family members. Natalie is involved in many different other types of cross-border work, including structures involving unlimited liability companies, which will take up large portions of today's presentation. The other co-participant in this presentation is Ray Hupfer, and Ray is a partner in Alberta more towards the west side of Canada, and he's with McLennan Ross, dealing primarily in estates, trusts, and taxation practices. Ray's a terrific guy, and he offers special expertise by virtue of his chartered accounting background. He's a leading practitioner in Alberta and advises clients in a host of corporate, individual, tax-effective estate planning, business succession, and other matters, including dispute resolution matters with the Canada Revenue Agency. Although Ray is based in Alberta, he practices throughout Alberta and plays golf just about anywhere he can. Ray, I'll turn it over to you.
Thank you very much, Michael, for that kind introduction. I play golf, just so you know, wherever I can, but I play it very poorly everywhere. I
would have never said that, Ray.
That you haven't played with me, Michael. Thank you. My task here is to discuss the different business structures that are available for U.S. enterprises entering Canada. And as always, there are choices, and with those choices come trade-offs and compromises, complexity, expense, less expensive, and so forth. So what my objective is for the next few minutes is to talk about the different structures that are available, what the trade-offs are, and what we're typically seeing, at least in Alberta, and I think our Alberta experience is probably the same elsewhere in Canada, what people tend to be doing and where the comfort level is with business structures for investment in Canada. Of course, my experience in Alberta typically with businesses coming in, it's oil and gas generated, whether that's in the service industry, the actual exploration, and also in the construction business. Now, having said that, there are sort of typically four broad choices that you can use to come into business in Canada. First is just a direct operation in Canada through a branch of your U.S. business. The second is what I'll refer to as a kind of regular or Canadian subsidiary corporation, and that's our standard limited liability corporation incorporated in any of the provincial jurisdictions or federally. The third choice is a what we call an unlimited liability corporation, which is a unique type of corporation permitted under the laws of Nova Scotia, Alberta, and British Columbia. We'll talk about that later, but its unique features is a bit of a hybrid, and it can be treated as a flow-through vehicle for U.S. purposes, hence the attractiveness to U.S. investors. It's something I understand familiar to them and something that works in terms of U.S. tax planning. The last one we'll talk about fairly briefly is the use of a partnership in Canada. Okay, so let's start in Canadian branch. A Canadian branch, that's really just the U.S. entity coming up directly into Canada and carrying on business. And frankly, this is what we see many U.S. corporations coming to Canada almost stumbling into, because what seems to happen is an opportunity is identified in Canada. The U.S. corporation will send one or two people up here and encounter all of the issues that Colin talked about, and they'll start operating and carrying on business. That's fine, and that's just something that's done. However, it's typically done as we find it. Often there's not a lot of thought given before this gets undertaken. Couple issues, obviously. The U.S. business is carrying on operations directly in Canada, and from a tax point of view, of course, it's not a flow-through. It's actually carrying on business here, so there's not a particular issue with any income being picked up. And if you're going to lose money the first little while, it kind of can make some sense because you can use the losses against your U.S. income. However, there's no liability protection. All the assets of the U.S. parent are exposed to activities in Canada, which often isn't very attractive. Got a lot of filing requirements in Canada. You've got to do financial statements for the branch that are going to have to comply with both Canada Revenue Agency and the IRS. A stumbling block and a challenge in all of this is if there's allocation of overhead expenses from the U.S. to Canada. Both sides of the border will look at that to decide if they're reasonable. Lots of reporting requirements. If you dispose of property, you're treated like any other non-resident, maybe withholding tax on services provided in Canada. So there can be lots of complexities. The other one is if you decide later that business is going well and to move it into a corporation can be somewhat problematic. You can incur some tax, or you have to try and get into what you would call a non-recognition. We call a rollover transaction to defer the tax. Those can be a little bit complicated depending on the circumstances. In terms of taxation, Canadian corporate rates federally are 15% and provincially range from a low of 10% to a high of 16%. So our overall corporate tax rates between 25 and 31%, depending on where you are carrying on business. There's also a branch tax of 25% of the net profits in Canada. However, the good news is there's a lifetime exemption for $500,000 of Canadian income. And the branch tax is reduced to 5% under the treaty between Canada and the U.S. So what this really results in then is at the end of the day, a branch is taxed at roughly the same as you would if you're carrying on business through a corporation in Canada. However, one significant difference is that the branch tax is imposed in the year of profit as opposed to the year the money is repatriated. So there's a bit of a timing issue and cash flow issue there if that matters. But having said that, it's simple, get you started up here, and there's no particular issue with respect to foreign tax credits and so forth. Next one we are starting to see more and more people is just the incorporation of a regular Canadian subsidiary. That would be a corporation, just incorporate under any of the provincial statutes, or you can incorporate federally if you choose to. That corporation, because it's incorporated in Canada under Canadian statute, is deemed to be a resident of Canada for Canadian tax purposes. And as well, as I said, the three provinces, British Columbia, Alberta, and Nova Scotia, allow for an unlimited liability corporation, which I'm going to touch on in further detail later on. So there, a Canadian corporation is going to be taxable on its all of its income earned, and as I said, that tax will be anywhere between 25 and 31%, depending on the province. Now, dividends paid by a Canadian corporation to its U.S. parent are subject to withholding. The Act says 25% reduced to 15% under the treaty, and further reduced to 5% if the U.S. entity owns 10% or more of the voting stock of the Canadian corporation. And that's almost invariably the case. So the withholding will be 5% when funds are repatriated from Canada to the U.S. So, and that's, of course, paid by the payor. Now, of course, the disadvantage to all of this is that the corporation is taxed in Canada, and because it's a regular corporation, there's no flow-through of that income or those foreign tax credits paid to the U.S. parent. On the other hand, a number of U.S. investors are looking at using these corporations, and if they're looking for after-tax funds to finance future expansion, there can often be a tax deferral by having the income taxed in Canada, not repatriated to the U.S., and left in the Canadian company for reinvestment. Now that's a jurisdiction by jurisdiction test, depends which province you're in, depends what your tax rate is in the U.S. But that's something that has changed the thinking of people a little bit in the last few years, given that Canadian rates are now where they are. The only, and talk about on this slide the payment of dividends by ULC, they don't typically get the treaty benefits, but as I'll talk about in a few minutes, we've come up with a couple of strategies that the tax department sanctioned to keep the withholding at 5%. Now, I think I've pretty much covered off this slide now, the taxation in Canada on the income of a Canadian subsidiary corporation. And as well, this is the tax rate that the ULC will pay in Canada as well. So there's no difference in the taxation of a regular corporation and a ULC in Canada. They are taxable and pay tax at the same rates. There's no differentiation. Now, ULCs, as we said, these are kind of a special type of corporation, unique to Alberta, British Columbia, and Nova Scotia. And they're still a separate legal entity. They're incorporated almost exactly the same way a regular company would be, except there's a few special provisions in the what we call Articles of Incorporation here that provide that shareholders have unlimited liability exposure. Now, that's something that varies between the three jurisdictions. Some of them have exposure for a longer time frame and both after and before you became a shareholder. So it's something you need to look at in a very focused way before you get into one of these. One thing, though, I have found in practice, not invariably the case, but often the choice of which jurisdiction to use a ULC in will be dependent to an extent upon the jurisdiction where the company is going to be carrying on business. So it might be that that's one of the more driving forces. Incorporation of a ULC, as I said, isn't any more particularly difficult than incorporating a regular corporation. It can be usually done in a day or two. The only stumbling block is if there has to be a name search done and getting the right name, that there won't be conflicts. The unique value, though, to a ULC from a U.S. perspective can be treated as a look-through for U.S. purposes. It's still taxed in Canada, but on a U.S. basis, treated as a look-through. And that's what has typically the attractiveness to someone in the U.S. That's going to be using this to carry on business in Canada. There will be the taxes paid will be flowed out typically as a foreign tax credit to the U.S. parent, and they pick up all the income and or loss of the ULC on an annual basis. Because of the unlimited liability feature, we often handle that by putting a blocker in between the U.S. parent and the ULC because of liability concerns. And that's where it gets a little bit more complicated and I guess expensive from a business point of view. Is using a regular corporation, you just got one entity, one to look after, account for, pay the annual fees to maintain it, as opposed to if you go into a ULC structure, there's now two corporations. If the operations are of a significant enough size and the look-through feature or the flow-through feature of the ULC is important, then it's probably not an inordinate additional expense. But it is something to do, and typically it would be done ideally at the start of the structure rather than partway through. A couple of simple examples. I don't want to too much get into. I'll just let you look at them. But the first one, U.S. individual using an S company as a blocker. You'll see the ULC, pays its corporate tax, and then it can still get down to a 5% withholding on the dividends. And what it says there is when PUC increase technique is used. So if there's a direct payment of a dividend by a ULC to a U.S. company, it does not get the treaty protection. The technique we've been using is we do what's called a PUC increase. And for Canadian tax purposes, a PUC increase results in a deemed dividend or a dividend, which would then be, since it's going cross-border, would attract the withholding tax at 5%. And then the day after that, what would happen is we would then reduce that PUC and pay the money out to the shareholder. So it's a little bit of a complication. The problem is you have to remember it's got to be done every time you pay a dividend and move funds out. So it's a little one step more than just paying a straight dividend. Okay. U.S. individual then will pay tax on the income of the ULC, and should get a full foreign tax credit. So pretty efficient structure, assuming that you wish the income to be flowed through and taxed in the U.S. Same thing here again with a U.S. C Corp carrying on business through ULC. Probably wants a blocker in between, and it'll get the same result as we described in the other example. So a pretty tax efficient structure from a Canadian point of view is you're going to pay the Canadian corporate rate and 5% withholding on the dividends. So that's as good as you'll do in Canada, and if the flow through matters to you in the U.S., this would be your structure of choice. Other thing here is, and these are a little bit problematic, is when you got an LLC carrying on business in Canada through a branch or the shares of a Canadian sub, these have never not been particularly favorably viewed by the Canada Revenue Agency. They've historically taken the position that a LLC doesn't get benefits of the treaty because for purposes of the treaty it has residency issues. That got changed in 2009, so you now do get some treaty protection, but that's not quite the end of the story. It gets complicated in practice because the U.S. shareholders might get the benefit. Canada still looks at the LLC as the only taxpayer. So it doesn't treat the LLC as sort of just a fiscally transparent, or just if it doesn't exist, doesn't substitute the shareholders for the LLC as a taxpayer. So that can get a little bit complicated because you can run into problems where you might not withhold the right amount of tax on the dividends, because if you've got shareholders that aren't corporations and don't fall within the exemption levels, then you won't get the reduced treaty rate on dividends. And the problem there is if the payor pays out these dividends and only withheld 5% and say should have withheld 15%, then the obligation is on the payor to make up that money, and that would be your Canadian ULC. Again, got to file LLC has to file a Canadian tax return and then get into claiming the benefit of Article 4.6 under the treaty, and has got to give documentation to support that. So it gets a little bit complicated and a little bit onerous to satisfy all this. And how you can avoid all of this, of course, is not having the LLC own the ULC directly. You should have the C Corp or S Corp in between, and you'll likely solve all of those particular issues. So it's something to be mindful of, and there's a few pitfalls and landmines out there as you start to carry on business if you're coming in directly into Canada with an LLC or an LLC directly owning shares of the Canadian entity, which would be a ULC. Just see that we went through the example before. S corporations are okay, but LLCs, the tax department treats a little differently. So it's kind of difficult to understand why they've done it, but it's a fairly easy issue to circumvent. So I wouldn't suggest getting into a structure like that unless you're prepared to deal with the complications that arise. I'm just going to skip to the last few slides because I want to talk briefly about the comparison of the ULC jurisdictions. There's a number of slides with the chart. Those compare the three jurisdictions or the fees, different issues with respect to unlimited liability and so forth. I don't propose to go through them. Everyone can read them, and they're also in some materials that will be available on the Meritas website. So I'm just skipping through all those slides, and then we'll talk. Last thing, we talk about a partnership. For Canadian purposes, partnerships are not a taxpayer, but income and loss is calculated at the partnership level, and then at the year end of the partnership, that income or loss is allocated to the partners based on their percentage interest in the partnership. Partnership agreements are typically a little more difficult to get done and in place rather than a simple incorporation. It can take more time. In terms of liability, of course, for a general partnership, everybody has unlimited liability. That issue in a partnership can be resolved by doing what's called a limited partnership, where you're only liable for what you've invested in the partnership and nothing more. But having said that, if a if the business is thought to generate loss in the first year or two, with a partnership you get the flow through of the loss to the individual partners, subject to some very complex at-risk rules which simply say that to the extent that the partner has an amount at risk, he can deduct losses up to that, but not in excess of that. So the last thing is just a quick summary is that there's no sort of magical answer for this. Much of it depends on a U.S. point of view as to whether the flow-through is desired, whether you wish to match the timing of the income in Canada with the U.S. and the foreign tax credits. If that's an issue, then probably the most popular and simplest structure to put into place is a ULC. If that is not an issue and you're prepared to accept taxation in Canada without a flow-through of the corporate tax paid, then the easiest and simplest way to get into business would be a regular corporation. Those are my comments. Thanks, and I think I'll turn it back to Michael now.
Thank you very much, Ray. That was great. And we'll move on now to dealing with financing Canadian operations. And this, again, is a joint presentation, but by two members of our Quebec affiliate group, BCF LLP, Robert Korn and Marc-Andre Belanger. Both are terrific guys. Robert is a partner in the taxation group and his practice focuses on taxation and estate planning. He too specializes in domestic international taxation, deals with all sorts of things including asset and sale transactions, business startups, corporate reorgs, cross-border structures, family planning, and succession planning. He regularly advises Canadian, U.S., and foreign private, public, and international entities. And Mark, also a partner at BCF, and his area of specialization is corporate tax. Mark's developed Marc-Andre, has developed terrific expertise in Canadian and U.S. international taxation. He, in the corporate area, works on mergers and acquisitions, reorganizations, restructurings, and financings, both in the private and public sphere, and internationally he's involved in developing and implementing cross-border acquisition and financing structures. I will now turn it over to, I believe, Robert, who's going to start.
Michael, thank you. Hi, everybody. In our 20-minute presentation, the outline that we're going to cover includes looking at debt and equity in terms of the financing of Canadian operations, deductibility of interest expense in the Canadian company, withholding tax specifically on interest, using Canadian disregarded entities, double-dip financing structures, as well as a brief mention of refundable research and development tax credits. So we've set up a company in Canada, and now we have to ask the question, how are we going to finance the operations? And when we speak about financing, really there's two things to think about. There's debt, and when we think of debt, we can think about interest payments on that debt and the related withholding tax on the Canadian side. We also can think about equity, and when we put an investment into a Canadian company and we want the return of that capital invested, what are the tax consequences? Debt in Canada essentially looks at a legal form of what debt is. There's no specific definition for tax purposes. It's considered in its usual sense, and that the tax ramifications will usually follow what is the legal characterization of debt. So the question is there a legal obligation to pay back money? I think it's a little bit different, as our understanding is in the U.S., where with certain kinds of instruments that are not typically considered to be debt, they would be based on more of a substantive approach in reviewing that instrument. So when we want to repay capital that's invested in a Canadian entity to its shareholder, the Canadian company can do so basically at any time without any Canadian tax consequences. And I say that with one exception, and that is recently announced Canadian foreign affiliate dumping rules. And just briefly, a foreign affiliate is essentially a foreign corporation of which a Canadian company, along with a related corporate group, owns at least 10% of the shares of that foreign company. And these rules were essentially designed to prevent the dumping or bringing a foreign affiliate as a subsidiary of a Canadian company that would otherwise not be a subsidiary of the Canadian company and would remain outside under the ownership of another company in the group. And there has to be a business purpose for bringing this foreign affiliate underneath the Canadian company. The Canadian tax authorities have found that this is it can be abusive as a way of extracting funds out of Canada by paying a certain purchase price to for the foreign affiliate shares to a parent or another company in the group. You can also be abusive where you issue shares as a purchase price and then try to return funds to that parent or that other company by way of tax-free returns of capital. We're now going to look at the idea of interest deductibility. And when we talk about interest deductibility, we're really talking about two different kinds of interest. You can have fixed interest, a fixed interest rate attached to a debt, or participating interest. And we're going to see a little bit later on the important distinction between these two for Canadian withholding tax purposes. In order to get a deduction for interest in Canada, you have to look at the use and the purpose of the funds that were borrowed. And essentially that the money borrowed needs to be done so for a purpose of earning income from a business or from property. The interest only needs to be payable by the Canadian company in order for it to deduct the interest expense in the year. It doesn't actually have to be paid. So it is an interesting way to reduce Canadian taxes without having an immediate outlay of cash. And if we're dealing with non-arm's length parties, which essentially non-arm's length is a question of fact, but when we talk about a related group of companies, we're dealing in the realm of non-arm's length, then there is a requirement to pay that interest before the second year after the interest deduction was taken. So for example, if you took an interest deduction in 2013, you'd have to have it repaid before the end of 2015. If it's not done, the amount that was unpaid is added back to the income in the following year or in 2016. There is an election that can be made if you want to avoid paying the interest, if the Canadian company wants to avoid that interest payment while still preserving the deduction. You can elect for Canadian tax purposes to treat it as if it had been paid. And normally, when you deal with non-arm's length parties, there is Canadian withholding tax on that interest, so Canada would be able to collect its share of the tax. However, as we'll see later on, that in the U.S. context, there is an exception for a U.S. recipient, even in a non-arm's length circumstance, as a result of our tax treaty. Very briefly, when we deal with leverage buyouts, usually if there is a Canadian acquisition company that's set up to acquire a target, a Canadian target, and funds are usually borrowed by this Canadian acquisition co to acquire the target, we will usually merge the target and the acquisition company so that we ensure that the interest deduction and the business operations end up in the same entity. We don't have the consolidation for tax purposes that you do have in the U.S. So this is a usual tax plan. And once that's done, the cost base that's in the shares of the target, which disappears on the merger, can often be salvaged by increasing certain non-depreciable capital assets that were previously owned by the target, such as shares of a foreign affiliate. The last thing here I want to say about is an important element is about transfer pricing with interest, because if you don't deal at arm's length, the interest deductibility needs to be reasonable. If it's not a reasonable rate, the deduction can be denied to that extent. And if the interest amount that you're dealing with is material, it is certainly recommended that a transfer pricing analysis be done, which would essentially determine what is an appropriate rate of interest between parties that were not dealing at arm's length. So you would look at the industry and risk of operations and review assets and liabilities of the borrower, and if there's security or not, and so on and so forth.
Thank you, Robert. So to continue on the deductibility of interest, in the Canadian context, it is important to take into account the Canadian thin capitalization rules. Basically, these rules would limit the deductibility of interest or deny the deductibility of interest if a certain debt equity ratio is not satisfied by the Canadian subsidiary. For example, like if we have a U.S. corporation with a Canadian subsidiary and intercompany debt has been used, we have to, in order for the debt on the intercompany debt to be deductible, there's a need to satisfy the debt equity ratio. It's similar to what there is in the U.S., like basically the earnings stripping rules. The debt equity ratio is important. It's important to keep in mind that it has to be tracked on a monthly basis because we're making an average of the monthly debt and equity. So we do an average of on the monthly. It's a monthly computation, so we do an average of that for the year. So it's important to keep in mind that this has to be tracked down on a monthly basis. Under the old rules of the Canadian tin capitalization rules, the debt equity ratio was 2-to-1. Starting this year, the debt equity ratio is now 1.5-to-1. So it is important if you have clients in Canada and there's intercompany debt, you have to make sure that you adjusted your debt equity ratio to now satisfy the 1.5 ratio rather than the old 2-to-1 ratio. The debt that is relevant for the Canadian tin capitalization rule generally is the debt between a 25% non-resident shareholder of the Canadian subsidiary. So for example, if we have external debt borrowed by the Canadian subsidiary, that debt is not taken into account in the debt portion to determine whether or not we meet the 1.5-to-1 debt equity ratio for tin capitalization purposes. Furthermore, interestingly, even if that external debt owed by the Canadian subsidiary to a bank, for example, would be guaranteed by its U.S. parent, that debt would still not be considered as debt when we determine the debt equity ratio, 1.5-to-5. So basically, if we look at the Canadian tin capitalization rules, it gets more favorable or more. It's not as limited as it would be under the U.S. earnings stripping rules. The clients are often a bit surprised by the way the ratio is computed. Another consideration is that another point is that there's no consideration to taxable income when you determine whether or not the tin capitalization rules apply in Canada. They apply to partnership having corporate partners, Canadian partners. Although they don't apply to trust. This could be very interesting in some cases, using a trust to make certain acquisitions or carry on certain activities in Canada, so that we don't have to limit ourselves to a 1.5-to-1 ratio. Although other consideration must be taken into account if you use a trust. Under the new rules, any disallowed interest under the Canadian tin capitalization rules would be considered as a deemed dividend. So this could attract Canadian withholding tax. And normally, in the context of Canada-U.S. treaty, we could assume that the rate should be around 5%, unless there's a problem with the limitation on benefit or other technical issue with the treaty.
Thanks, Marc-Andre. Now we're going to turn to the withholding tax. Under Canadian domestic law, there is no longer withholding tax in the realm of fixed interest since January 1st, 2008. And this is on arm's length interest payments. So this would apply to an interest payment made to a non-resident in any country. However, under our domestic law, there is still withholding tax on participating debt interest. And participating debt interest is essentially defined as interest that's somehow computed by reference to a financial measurement of a corporation. So it could be revenue, profit, cash flow, dividends. It's a very broad definition. It's somewhat different under the treaty with the U.S., but it's very, very broadly worded under our domestic law. And we come up with one sort of contentious current issue when we deal with convertible debentures. You can imagine the question that can arise is if you have whether participating debt interest exists in the context where you have a convertible debenture and the debt is essentially exercised for the conversion. So the debt is assigned and canceled to the Canadian company. In exchange, it gets back shares of the Canadian company. And those shares would essentially have a fair market value that exceeded the original principal of the debt. And it's controversial. Our Canadian tax authorities have come up with recent interpretations on the point, and all that they've said is that on traditional convertible debentures, and so they list conditions and characteristics surrounding these kind of debentures, including that it's done by a public company. They would not take the position that a premium on the conversion would be considered interest. However, because there's such a variety of terms that can be attached to these convertible debenture issuances, this is a tax issue that needs to be considered in advance of any implementation in case we run afoul of the participating debt interest rules. Now, under the Canada-United States Tax Treaty, there is no withholding tax on fixed interest, as mentioned. Now, this is whether or not we are dealing at arm's length. So that is the difference between our domestic law, that if you are dealing at arm's length, there is no withholding tax, again, unless it's participating debt interest. We can't forget that in order to get the benefit of the treaty, so if you are dealing in a related corporate structure, you have to still meet the limitation of benefits conditions in the treaty, essentially an anti-treating shopping rule. This rule is now reciprocal, and so Canada can enforce it to deny treaty benefits in certain circumstances. If it is considered to be participating debt interest, by the way, the withholding tax rate will go to 15%.
Okay. That's important to really stress the importance of the limitation on benefits in the Canada-United States Treaty. I see on a monthly basis situation where that issue comes up, and it's the only treaty where we have a limitation on benefits. So we have to be very careful with that issue. If we go on a structure where we have basically, as Ray discussed earlier, we're using a Canadian unlimited liability company to carry on business in Canada, and we have the U.S. parent forming the Canadian unlimited liability company, and the Canadian unlimited liability company is financed with debt. The question is how the interest paid by a Canadian ULC to its parent, its U.S. parent, how it would be treated. It's really, you have to be very careful in that context because of the Article 4, Paragraph 7, the Canada-U.S. Income Tax Treaty. Because in that context, since the ULC is disregarded for tax purposes in the U.S., the situation would be that we could have a situation where, because the interest paid by the Canadian ULC to its parent is not recognized as income in the United States, this will create the application of Article 7. This means that the treaty will not protect the interest from Canadian withholding tax, and it would be a situation where the withholding tax would be 25%.
Now, just to show an opposite situation, I think was alluded to also earlier by Ray, if you had more than one shareholder of the ULC, so essentially we'd have a situation, you'd have a properly capitalized debt-to-equity ULC, and for Canadian tax purposes, it's going to be considered as a corporation. In the U.S., it's considered as a partnership. But the rules work differently because when you do the analysis, in the U.S., as we understand it, if a loan to a partnership is considered a bona fide debt, then it's still treated as a loan from a third party. And so the lender is going to report the interest income, and the partnership gets to deduct the interest paid. So if the ULC then were not fiscally transparent, so if you're doing this analysis under the Article 4.7 to say, well, if it wasn't fiscally transparent for U.S. tax purposes, well, the lender would still recognize interest income from the loans to the ULC. And so in this kind of a scenario, when you had two or more shareholders, then this Article 4.7 would not be applicable, and there would be no withholding tax under the treaty on the payment of interest. Now, if you get into trouble under Article 4.7, there may be other means of dealing with it. Ray had mentioned some earlier. You can also maybe look at an entity higher up the chain in the U.S. to pay interest to instead of the immediate parent of the Canadian ULC. Or we have seen files and worked on structures where we go to a third jurisdiction where there is a favorable treaty with that jurisdiction in Canada, and we don't have this Article 4 to have to deal with.
Still looking at the financing of the Canadian subsidiary, in certain files, if the amounts are require an analysis in that regard, we could look into trying to get a double dip with respect to interest deduction. So we could try to look into double dip financing structure into Canada, inbound Canada. The old structure that used to be put in place in that context was basically where you would use hybrid entity financing structures. Following the fifth protocol and the enactment and the enter into force of Article 4, Paragraph 7, we just discussed before, the use of the hybrid entity financing structures became pretty much impossible. So what happened is we went back to the previous structures that were used, and basically the double dip structure, what's being used is an hybrid instrument, which is basically considered as debt for Canadian tax purposes and as equity for U.S. tax purposes. Basically, you would very generally, because it's a very complex structure, but basically from a Canadian standpoint, you would have a secured loan made by the U.S. parent to its Canadian subsidiary. So the first step would be we would assume that the U.S. parent would borrow money from a bank, pay interest to the bank, use that money to make a loan to its Canadian subsidiary. And for Canadian tax purposes, the interest, assuming we meet the 60/40 thin capitalization rules, debt equity ratio requirement, the interest would be deductible in Canada. So we'd have a deduction in the U.S., but a deduction in Canada. In between Canada and the U.S., obviously, if there's only a payment of interest and the loan is considered debt for U.S. purposes, there's an inclusion in the U.S., so we have an offsetting deduction, so we don't achieve the double dip. So we add in that context the secured loan, the forward subscription agreement, which combined with the secured loan, our understanding in our file is that U.S. tax advisors consider that these instruments as one instrument that would be equity for U.S. tax purposes. So when the Canadian subsidiary will be paying interest to the U.S. parent, that interest could be paid under the loan agreement with shares. And in that context, you get a situation where there's no income pickup in the U.S., so that's the way you achieve the Canadian tax, the deduction for the interest expenses in Canada and the deduction in the U.S. for the interest paid to the bank. So keeping this is a complex structure, but it's being done, and it's so far we've seen U.S. tax advisors taking the position that in that context the instruments would be equity. So it allows us to take advantage of a double dip structure, and on the interest there would be no withholding because of the treaty. So that's generally how it works in that context.
Thank you, Marc-Andre. Lastly, we don't have much time. I just wanted to make mention, I think it's important that Canada it offers very attractive refundable research and development tax credits. And a significant number of Canadian companies rely on these R&D credits for their survival. And you get a check from the federal government, refundable tax credits. You get one from the provincial governments. Each province has a program as well. We mentioned Quebec here because it's one of the most generous programs amongst the provincial ones. The refund is based on R&D expenditures. Those things would include salary and wages, cost of materials, lease of machinery and equipment, and even subcontractors. It's only refundable if the entity doing the R&D is a Canadian-controlled private corporation, therefore not controlled by one or more non-residents. You get back 35% of your current expenses up to $3 million. Over $3 million, the refund rate gets reduced. And essentially, the size of the entity in question also matters in terms of taxable income and in terms of taxable capital used in Canada. So there are ways to structure the operations in Canada to maintain CCPC status. Even in situations where that is not possible, there are also alternative structures where these refundable tax credits can be accessed. And just want you to keep this in mind, since it can be a material effect in reducing the overall business investment costs of coming into Canada. Michael?
Thanks, gentlemen. That was terrific. Before introducing our next speaker, I just want to remind you that if you want to send any questions to us, you can use the chat box, and we'll either try and answer them at the end if there is any time, which I doubt, or individuals to whom they're addressed will try and get back to you. The next speaker has embraced different corporate attributes in terms of the rest of us being partnerships, and the Boughton Group seems to be incorporated. So Scott is actually a shareholder and the leader of his firm in BC, Boughton's Tax Group. His practice focuses on Canadian tax planning and tax-driven commercial transactions. He's assisted both private and publicly listed corporations with developing broad ranges of strategies to assist them with all of their various tax planning needs. Given how little time I have, I'm just going to say, Scott, take it away.
Okay, thanks, Michael. I have the privilege of speaking at the end of this presentation, which I commend you all for sticking in with. It gets to be a complicated area, and we've gone from probably the most generic, most recognizable situation when you have people traveling across the border to come and work here for a U.S.-based corporation and how that might affect you tax-wise, to now maybe the most esoteric of topics today, which is transfer pricing. Given our time that we have left, I just want you to keep in mind as I go through some of my slides here that the overarching theory behind transfer pricing is that high tax jurisdictions don't want profits to travel out to low tax jurisdictions. They want the entities that pay tax in those jurisdictions enjoy all the benefit that those jurisdictions provide to be taxed there, and that's no different with Canada. In that respect, that's the simple explanation of how transfer pricing works. But as you can see from my outline slide, transfer pricing is an exercise in making the most elementary thing as complex as possible. And whole departments in international accounting firms are built around what is essentially one section in our Income Tax Act. So I'll just jump right in here. In the transfer pricing, just to give you some context here, it's, as I said before, or started to allude to, it's the practice of establishing arm's length prices for related cross-border transactions. And the overarching theory behind transfer pricing is that the related parties, in this case we're talking about parents and subsidiary corporations, should abide by the arm's length principle, and meaning that they should have the same prices that they're charging each other for their services and goods as they would charge for third parties to try and make a profit that's taxable. The tax authority in Canada, the Canada Revenue Agency, will want to see that an entity resident in their jurisdiction is not paying more for services rendered outside its borders to a related party. And put another way, there's to be no price markups that create an artificial drain on revenue that ultimately leaves our CRA with less profit subject to income tax in Canada. And I'll talk about a couple of cases that have come down and how that's affected how U.S. companies are being audited. All of these principles are based on OECD requirements, and Canada has adopted those guidelines into our Income Tax Act, as you see on the slide. And the U.S. Is a member nation of the OECD, and so they've got their own set of transfer pricing legislation that is similar but not quite exact. And that brings me to the perspective of this particular presentation. I just mentioned that the United States has transfer pricing legislation of its own. Its application is slightly different. And we in Canada are supposed to respect the fact that U.S. businesses are applying transfer pricing legislation that they have to abide by, and at the same time try to abide by Canadian transfer pricing legislation. But I've seen a few cases under audit where that understanding just doesn't quite come through. And I'll explain a case at the end of this presentation where that actually happened. Okay, so and the main elements here, as you can see, transfer pricing, it's applicable to a broad range of things: services, tangible property, and intangible property, as these are offered, sold, or traded across international borders between related parties. So that doesn't leave a lot of room for exceptions. It treats parties dealing at arm's length as if they were operating, not dealing at arm's length, as if they were operating as separate entities. And as I said before, the main evil that the legislation seeks to prevent is that corporations are diverting their high-priced goods and services offshore, their profits offshore. And intangible property is something that's misused a lot in this transfer pricing context, and it includes things like rights to use patents, trademarks, trade names and designs or models, and intellectual property such as know-how and trade secrets. We had a client come through the office who, believe it or not, ran a sweepstakes business, which is, we have a limited scope to run private lotteries here in the province, and they happened to be running one. And they had visited another tax specialist to set up a structure where their calling list, which they called their intellectual property, was housed in a Luxembourg structure, and they were diverting profits for the use of that calling list offshore. And they didn't have any transfer pricing strategy to account for that. And they thought they had all the bases covered, but when the CRA auditors came in and conducted an audit and they discovered these payments going out, they really fell apart in their transfer pricing strategy, and they ended up being quite exposed. So how they do that is they look at, well, what would somebody normally pay for such a list? And that they would call that an uncontrolled transaction. And they compared it with the controlled transaction, which was a series of payments between the related parties. And they said, well, that's just unrealistic. And that's the basis of how transfer pricing is applied. They take controlled transactions between non-arm's length parties, see what they're paying, and they compare it to uncontrolled transactions. And there's a bit more to it, obviously, when you get into the details, and they call it a transfer pricing comparability analysis, or sometimes called a functional analysis, and they try and discern the true transfer price. So once they figure out there's a difference, they then provide a service of figuring out what the actual transfer price is for you. And if it gets that far, the CRA usually chooses a transfer price that is not very favorable, or at least unexpected. And it includes an understanding or an attempt at understanding the controlled transactions by measuring them against reliable comparables. And I've got that in quotations on my slide because there's a database that the CRA maintains that has reliable comparables for all sorts of companies that meet different profiles. And they choose different companies in their database, and they measure them against the company that they're looking at. And they're attempting to figure out what transfer price is appropriate for a transaction that they're looking at. And as you can see from the next point there's no set process that's mandated in legislation, but there's a process that's set out in a series of transfer pricing memorandas, and that's the TPM is Transfer Pricing Memoranda 14, and it says that they will then look at the affairs of the taxpayer closely and look for internal comparables and external comparables, and it gives them the authority, they believe, to impose upon a particular business transactions and transfer prices that other unrelated taxpayers are using. And the authority for making adjustments once they figure out there's a difference is under our subsection 247.2. And the adjustments can be quite punitive depending on how far off the mark you are. And the basic authority that they have is that they say the taxpayer would not have entered into this arrangement with another person who's not dealing at an arm's length with. And it can be reasonably considered not to have been entered into primarily for bona fide purposes other than to obtain a tax benefit. I quoted that section because it's very similar to other sections, including our general anti-avoidance rule, thin capitalization rules, and other rules in the Income Tax Act that bring in an object and spirit test to this. And I'll get into some in later slides as to how you can attempt to comply and avoid some penalties, even if ultimately your transfer price is found out to be wrong. But returning to the adjustments themselves, and I said to you that they can be quite punitive, what actually happens is that once our adjustments are made to the transfer pricing, they then lead to secondary adjustments from the imposition of these transfer prices. And if you're a U.S. parent, you wholly own a Canadian subsidiary, you then can be deemed to have a shareholder benefit as a result of these adjustments. And further to that, our Income Tax Act deems these benefits to be dividends, and then you have treaty withholding requirements that you haven't complied with or are deemed not to have complied with. And there's a 10% penalty on top of that for failure to remit. So these can be quite onerous and punitive, and it adds up very quickly. You must make reasonable efforts to comply, and compliance is not an option. There's an additional penalty in addition to the adjustments I just went through that's imposed if the taxpayer has not made reasonable efforts to determine and use the arm's length transfer prices that they have decided upon. Evidence of reasonable efforts is usually set out in a written agreement between the parties. So basically you get points for trying even if you get it wrong, as I said before. Where most taxpayers stub their toe is on a requirement for contemporaneous documentation. Once a CRA comes knocking on your door, it's often too late to get a transfer pricing strategy in place because a taxpayer is required to comply with a CRA request for documentation within 3 months of the request being served. And I think if you ask many accounting and law firms with tax departments that are familiar with transfer pricing, it's very difficult to get a complete and accurate transfer pricing strategy in place and demonstrate that it's being used over the many years that are under audit within 90 days. So when the CRA comes knocking, it's often too late. The documentation itself has to include sufficient information that demonstrates that the property or the service is sold or offered cross-border reflects a reasonable attempt to arrive at a transfer price. And again, the details of this are and what you have to show in the transfer pricing contemporaneous documentation requirement are in the series of transfer pricing memoranda, which I won't go into right now. And as I said before, there's a distinction that I want to make between the penalty provisions for transfer pricing, which will apply if you are not successful at arriving at a proper transfer price, and the efforts you make to determine and use an arm's length transfer price. You can have a very basic agreement that is built on sound principles that is applied and used, and good faith efforts are maintained. But that will avoid the 10% penalty for not complying, but you can still get the transfer price wrong. And that gets into the methodologies. The OECD guidelines used to mandate strict hierarchy methods, but that was relaxed in 2010 in favor of the most appropriate methods that apply to the circumstances of each case. And there is a hierarchy of methods that are preferred, and again, I think we don't really have time to get into all of them, but it looks like when you look at the case law and the legislation and the transfer pricing memoranda, that which methodology is important or most useful or appropriate in a given situation depends on the business. Sometimes you will have the reason to apply what's called the CUP method, which is a comparable uncontrolled price method. So you look at what third parties are charging for the same services. If you're not in a service-based business, you might manufacture widgets, and at that point you would look at transactional net margin for the sale of each widget. So it depends. But if you don't make a decision and put some thought into it, a methodology will be applied for you when the transfer pricing audit happens. I'll touch briefly on a very important case that came down October of 2012 last year involving a major drug company, GlaxoSmithKline. And it was important because the Supreme Court of Canada noted that the generic comparators that the CRA used in its original analysis did not reflect the economic and business reality of the taxpayer. The CRA in transfer pricing audit really attempts to isolate particular transactions that they believe are not being conducted properly and for which there's an overcharge in Canada, leading to a payment to a lower tax jurisdiction and less profit to tax here. In Glaxo, the Canadian operation paid 5 times generic market to a Swiss entity for a vital ingredient in Zantac that allowed it to sell Zantac at a premium in Canada. It resulted in a $51 million adjustment that obviously the taxpayer wasn't happy with. But the Supreme Court of Canada basically endorsed a contextual approach and rejected a transaction-by-transaction method, saying, yes, they paid a higher than market value for a particular ingredient, but they got all sorts of benefits out of it. And so a reasonable person, an arm's length entity, would enter into such an agreement. And they also noted that the Canadian subsidiary was still turning a 60% profit and paid its fair share of tax besides. So that brings me to my case study, because I want to paint that picture for you as to how that can affect an operation that's maybe a little smaller than GlaxoSmithKline. And we had come through this office recently, a U.S. engineering company, expanded into Canada through the acquisition of a Vancouver firm in 2007. Which you might recall, it was still pretty good economic times, and it secured quite easily some major contracts with a large oil corporation to build infrastructure. And the back office design support and etc. was performed in the United States, and site visits and installation was performed in Canada. And there were labor agreements and payroll adjustments made in an attempt to comply with transfer pricing requirements. It wasn't the scientific approach, but the agreement was basic and sound. As part of this operation, Vanco leased large office space and hired many engineers, which unfortunately the timing was bad. The economic crash happened. Vanco was stuck with the lease, and when the functional analysis was performed by the CRA to assess the profitability of Vanco as compared to long-established U.S.-based engineering firms, they found that Vanco failed that test because its net margins were way off what could be expected. So our audit defense focused on the existing services agreement, which again was basic, but it was sound and it went through all the elements. And we attacked the comparables that the CRA drew for us and the methodology that they applied, because we felt that the lease, which was entered into reasonably, was affecting the overall profit margin. They rejected that, and they were saying basically that in spite of that fact, the Canadian entity was paying too much for the services that were being performed in the United States. And they wanted to isolate those separate and apart from all the other things that were going wrong with the business. But we were ultimately able to establish that the activity was reasonable, but not until after the Glaxo case. So our timing was very fortunate. And our contextual approach, which was really the best shot we had, was endorsed by the Supreme Court of Canada back in October, and we just received our decision in January that they were going to vacate our assessments. So there it is on the next slide. Basically, the contextual approach we see now taking over, and it might be easier to set up and defend a new company coming into Canada that's perhaps not as profitable as some other comparators, but you still have to apply a proper transfer pricing strategy in order to get there and avoid all of the adjustments that could come, including a 10% surcharge on your operation if you don't address the transfer pricing issue at all. So I think, given the time, I'm going to end it there, because that's enough. That's about enough. I want to go into transfer pricing right now, and if there's any questions, I'm more than happy to take them.
Thank you very, very much, Scott. You did yeoman's duty there, and I know there's a bit of pressure on time for you. We went over by a couple of minutes, and we appreciate everybody staying with us. There was only one question about ULCs. I'm not sure whether we've got time to deal with that. It would be addressed to Ray, and perhaps Ray can respond directly to the individual. We want to thank you all so much for joining us today, for giving us your time. We're all available to try and answer questions, and in the event that some of us don't practice in an area, I know that we're quite happy amongst this group to send the business to the right place. So feel free to get in touch with any one of us today or anyone else at our offices. Thank you, and I'm going to turn it now over to Kim.
Wonderful. Thank you. I appreciate everyone for joining the great webinar today, and a special thank you to all of our presenters who put in a great deal of time in preparing all of the content. As Michael said, please don't hesitate to reach out to any of them. We will be circulating their contact details along with a link of today's webinar recording and a copy of the presentation within the coming days. And it will also be posted on the Meritas website. So thanks again,
Kim,
everyone, for participating. Yes, please go
Kim,
ahead.
it's Bill Cooper, and I want to thank you very much and your group at head office for making all this happen.
Absolutely, our pleasure. Thanks so much, Bill. Take care, everyone.
Bye now.
Bye-bye.
Thanks. Bye.
Thank you. Please stand by.